Hey everybody, welcome to another episode of Revolve Capital's Passing Notes. I'm Bob Repass, and again, I'm joined with our CEO and founder, Chaz Guinn. Chaz, how's it going today?
Yes, sir. Glad to be here and bring a different insight to the podcast and be able to have a different peering eye view into what we're seeing. We're seeing data now that we saw in 24 that's now starting to kind of show itself in 25, and I think the audience and the viewer needs to kind of see what we're seeing and help kind of get an understanding of what 25, 26, and the future market for real estate will look like. So,
well, at Revolve Capital, we started off the year with our, strategic plan, right? What do we have in the pipeline? What do we want in the pipeline? And a lot of that was data driven. And we thought, all right, well, let's sit down and share some of that data that's helped us make those decisions on what we're going after, for our capital funds and look at. So why don't we start off by talking a little bit about what we refer to as equity protected non-performing loans. Let's let the audience kind of, get a handle on what that is, and then we're going to show some charts and graphs and kind of dig in a little deeper.
Look, anybody that's stumbling upon an NPL, a non-performing loan, has heard about it happening in 2008 when everybody stopped paying on their mortgage and it actually went into default. But now you talk about, you fast forward from 2008 to 2025, and you're seeing there's an equity protected loan that's not paying. That's a very different trend to what started this pandemic in the first place. And when I say pandemic, not talking about COVID, but we're talking about a pandemic that went global, right? That actually forced a lot of folks that were having multiple mortgages collateralized by homes to stop paying entirely. So your home values began to plummet, and where your values were now less than what you owed, right? Where that's typically not the trend. If you buy a home, you usually have equity because you put a down payment, right, and there's already kind of a cushion built into that purchase.
So at that time, we referred to it as underwater
asset.
Right? They owed more than it was worth.
Now you fast forward. Now look at the shift. So in 2025, we're now looking at an underwater from a perspective of payments, not equity, right? So if it's a $400,000 home and you owe $250,000, so you have $150,000 on the surface, you haven't paid since COVID. COVID potentially caused your default, maybe a job loss. Maybe you had a death in the family. Maybe you had a divorce. Some of the 4 or 5 major reasons why default happens in the first place. But now, since that pandemic happened and equity has continued to rise across the country, we call it HPA, home price appreciation, as that has began to continue to balloon, the affordability has not also kept pace. So folks are unable to make their on-time payments, but still have equity.
Right.
So we saw this trend starting to happen in 2018 and 2019, even though the data hadn't been shown in the Wall Street Journal yet. But what we started seeing was around 2 out of every 10 loans had equity protection, but they were not paying 1 to 2 years. We're like, interesting trend, right? And then you fast forward to 21, 22, we started seeing around 4 loans out of every 10 were following this trend. Now, if you catch up to 2025, we're seeing 7 to 8 loans out of every 10 have an equity protection associated to it, but are in default. So you're thinking to yourself, well, why wouldn't they just stick a for sale sign, take on the equity and go rent, or start their life over again? And we're not seeing that trend happen. And the data's proving it.
It happens at times, right? Somebody
sure,
pre-foreclosure, they'll sell their home, take out whatever equity they can. But to your point about affordability, I think to some degree everybody was getting really excited that their house was just going up in value, right? And they were riding that equity. Well, guess what happens when your house goes up in value? Your taxes go up. Your homeowner's insurance goes up.
Continues.
All of a sudden, that affordability you mentioned became a key player. It's like they still couldn't afford to make their payment. I like the way you said now their payment was underwater, right? Because they were paying zero, right? And then all of a sudden they have taxes, insurance, and their regular principal and interest payment. They can't afford it, right? And then, okay, can I sell my house? Well, where am I going to go? Can I go rent? And then on the flip side, I think there's some equity protected loans that really aren't as protected as it's being made out to be.
What does that mean?
It means, to your example, $400,000 house, $250,000 that they owe, right? Not counting what they owe in taxes and insurance, right? Then all of a sudden, all right, I'm going to sell my house. Well, you have commissions that you have to pay, right? The house isn't up to date. So either you or the new buyer is going to have to do some rehab, which is going to affect the pricing of that asset.
Sure. Mm-hmm.
All of a sudden, that $150 in equity ends up being about 30 or 40, and they're like, I don't have as much equity. I'm just going to stay here and ride it out as long as I can, and that's where we come in and buy that distressed asset. And then we look like, okay, are we going to pursue the foreclosure angle, the deed in lieu angle, or the loan modification and let them retain home ownership?
And what we're starting to see is the homeowner knows that as well. They live in the home. They know that there's a hole in the roof. They know that the bathrooms need fully updating. They know that they haven't been able to have any sort of excess cash to be able to put into the home themselves, to be able to bring more value to the home. So even though the data may say that it has equity, 400 versus 250, we're realizing that that's being squished. Now that we're seeing that as a market standard now, right? We talked about last episode where NAV, net asset values, are being slashed across major portfolios and publicly traded companies. Why? Because homes aren't selling for what we think they're going to sell for. We think a home is worth X, and it ends up selling for Y. And what do they say in real estate? Your home is worth what people are willing to pay for it.
Exactly.
So even though you think your home's worth 400 and it's only selling and fetching 320, this is where we're starting to see the compression in what folks think is their equity value. And so we've seen this trend not only increasing, but this is where it's causing a liquidity consistency. I know it's usually a liquidity problem. It's a liquidity consistency here in the market where the balance sheets of major mortgage holders has continued to balloon with equity-protected non-performing loans, and they were not built to hold securities that no longer made payments. They were never built to hold a book of assets that they had of kind of a consistent outgoing amount of dollars that had to go to cure those loans. This is where providing a private sector investor to come in and say, look, we'll provide you liquidity, seller, and now let's try and figure out what's going to happen with these loans. But to kind of bring it home to you, we're starting to see this trend that started about 8 years ago is coming to now become a mainstay, because affordability now has really started to affect the everyday homeowner. Your 30-year mortgage is sitting at about around a 7,
Right?
And the same home prices that we still just said are about 20 to 25% inflated. So if you don't have the cash to put down, and you don't have the affordability because your job salary isn't increasing on a marginal basis to upkeep putting your down, where's there going to be a new surge of home ownership and suppliers and buyers? And this is why we continue to champion. Look at what we're doing. This is where supply is starting to come from. Let's
talk a little bit about that net asset value. Okay, let's take a look at some of the data here. You guys will see it up on your screen right now. Well, we're talking about why aren't properties selling at the foreclosure sale or even prior to that, and instead reverting back to the lender as REO, right? And the data will show you that most folks that go to a foreclosure sale want to buy that asset at a discount to where they're paying 55, 60% of that value. And why is that? Because they're not taking the value. They're taking the net asset value, which is less. So they may be paying or bidding 80, 85% of their NAV, right? But not of the value that, most people think that property is worth at this point in time, and it's reverting back as REO. And the wholesale investor is counting on the REO bank lender who now owns that to do a little rehab on it, whether it's trash out, what do they call it? Lipstick on a pig, a little bit of paint, carpet, whatever, and taking on some of that rehab cost. And more property, you and I all the time, well, this should sell at third-party sale, and it reverts back REO. And that's because of this NAV calculation that most investors are looking at.
Sure. And we've been talking a lot about the reversion of assets that should be selling at auction, because traditionally the auction platforms that are throughout the country, in all 50 states, they have these auctions that are held on a consistent basis that takes formal homes that used to be paying on an on-time basis, and the only way that you revert or take them back is through the foreclosure action. So usually there are private investors with cash that sit at these auctions that are able to buy these homes out of foreclosure or buy them from the auction himself. And we're starting to see that data is plummeting, right? This is some supportive data that we're sharing with you that month over month, quarter over quarter, the consistency of buyers that are showing up to the auctions is dropping, right? So the cash availability from the market, you would imagine, should be strong from the lack of supply that's out there, but it's actually becoming a detriment to how many folks are showing up at the doorstep to be able to take these things at auction. And that's because there is a disparity between what sellers are looking for and what buyers are willing to pay. And until that disparity is shortened and shrunk to a delta that allows folks to start participating again, I think we're going to see a bit more of a stagnation. And we're also, I think, we're going to see a stagnation on home buyers coming into the space. I mean, we talked about data as around 7 or 8 loans out of every 10 today across the active mortgage markets book, right, are sitting at a 5% mortgage or less. So if you have a 7% rate today, why would you refinance?
Right, exactly. And we can look at this chart right here. Mortgage rates have been above 6.5 for 7 consecutive quarters. Okay, those days of less than 4% mortgage rates, those
gone.
2.5%, 3% mortgage, it's not there.
Fairy tale.
It's 7 consecutive quarters. That's like going on 2 years.
Yes.
Right? So the rates are where they are. And even when the Fed cuts the rates, the mortgage rates don't automatically drop. Right? So to your affordability point, do you have 20% in the bank to put down? And then can you afford the rate on a 30-year 7% mortgage?
Right.
Why would you take your savings, put it down on the house, just to be squeezed on a monthly payment? Which, well, it's a fixed rate. Yeah, but we mentioned a minute ago, it's not fixed from the standpoint of taxes are going to go up, your insurance are going to go up, your maintenance, right? That house isn't just going to sit there, and it may appreciate in value, but something's going to break, and you're going to have to fix it.
And where's that additional disposable income that you would usually have in savings to then put down at that? Me and you were talking about how much the shift has happened in the last 40 years. We're sharing this data with you right now where we saw that the average home buyer was 28 years old in 1981 when they bought their first home. And when you fast forward to 2024, that person's almost 39 years old before they buy their first home. Look at the gap between the time you were in your 20s to where we are today on the ability to actually buy a home. And so not only are rates keeping people on the sideline, but the overinflated values are keeping people on the sideline. And not to mention some of the data we wanted to talk about regarding insurance, regarding taxes, regarding what's happening in California from these fires. And when folks actually look to rebuild, what are going to be the insurance premiums that get put on these homes? And can people afford the insurances? Not to mention the taxes, right? And so all of these, I feel like, are clogs that are going to eventually need to be unclogged for some of the streamline of the real estate business that keeps this economy afloat to be going again, right? Because to your point, almost 2 years, we've kept too many folks on the sidelines. We've kept too many builders from building homes, right? So at some point, supply has got to match up with demand because demand continues to be pent up.
Right. So I want to bring, just a little bit of reality to what you were talking about, okay? So I bought my first house in 1985. All right, I was 24 years old, lived in Raleigh, North Carolina. We bought a house in the suburbs, right around $68,000, $70,000, right? So, pretty good, still young, getting ready to have our first child, that next year. Now, my first child is 38 years old and has been renting ever since he left home, right? And the reason, even if he had 20% to buy an average house, which here in the Dallas-Fort Worth area is going to be, let's just be conservative and say $400,000, who has $80,000 as a 38-year-old that he can put down on a house and still have disposable income that you mentioned because he's going to have to, have money in the bank just in case and be able to afford that payment, right? And he's like, Dad, I'd rather just rent, travel the world, have money in the bank in case anything comes up, and I'm not going to buy a house right now. And he is not like an anomaly. I mean, it is the standard of that generation.
There's millions of millennials and younger that are going to be facing this exact issue. I mean, take Southern California, right, where I was originally from. I mean, the average starter home today is about $1.1 million. and that home still needs renovation, believe it or not.
And what kind of income do you have to make to
Thank you.
qualify for a $1.1 million starter home?
So in relativity, you mentioned 400,000, and you got to put down 20%, 80 grand. At 1.1, that's well over 200,000+. Right? Who's doing that at sub 38 years old today? So that's number one. Look, this is an interesting pivot, but we feel like it's a pivot where are they going to be able to get in? I think when the supply that starts to get unclogged from the distressed inventory makes its way to market and brings that NAV down and allows the values to be a lot more affordable, and rates begin to drop and allow more folks to be able to get into the space, this is where folks like your son, in my opinion, with affordability beginning to get tamed, right? Because there's a lot of factors that need to be addressed before so folks can actually get into the space. But first and foremost is we got to deal with rates. We got to deal with values. And we got to deal with the affordability around insurance and taxes. Right. That's 4 major headwinds that are going to need to be addressed, not only by today's administration, but also policy.
Right, and we're talking about first-time home buyers.
Sure.
For the most part, who's entering that market. And I want our audience to realize, like when you moved from California to Texas, you finally saw the light back in the day.
Amen.
Right? You had equity that you took out of your California property to be able to make that down payment on your new home in Texas. Right? So a homeowner moving from one home to another may be able to come up with that 20% from their equity in the house. But a first-time home buyer, they have savings.
Sure.
What little they may have. How are they going to come? Now, can they get an FHA loan, qualify for that, maybe put 3-5% down and get in there? Just to some degree, they can do that, right? But they are getting squeezed in the amount of people that are going to be able to live the American dream of being a homeowner, right? What's that going to look like 5, 7, 10 years from now?
That's where I don't see the sustainability, right? And we're not looking to provide a lack of optimism in the real estate market. We are looking to bring you kind of a data points that we're seeing sitting in the chair that we're sitting, right? We get to see a lot of industry knowledge that doesn't make its way to headlines or make its way to newsletters or podcasts for months after it's already been in place. We saw a lot of the NPL data, especially a lot of the equity-protected NPL data years ago. And it's just now starting to show itself where we can point to data and say, you see? And traditionally, what the things we're talking about now have got to be fixed, because I don't see where even my sons today are going to be able to get into the housing market at less than $1 million, right, and be able to have their current wages upkeep with what the values of the homes will be. I don't see how that's sustainable. So I think that, number one, needs to get addressed. Number two is, why don't we pivot just a little bit, right, and give not only a peering eye view into some of the headwinds we're seeing, but what additional factors we're seeing are creating these headwinds. And we're seeing that the inventory is continuously an issue, but we're also seeing spikes of foreclosure inventory continuing to creep up. We used to see it in pockets and regions, right, whether it was in the Midwest or whether it was in the Southeast or up in the Northeast. But now we're starting to see this foreclosure data spanning nationally, right? And whether you're in California and you just faced a natural disaster that is taking away billions of home value, or whether you're in North Carolina where we're seeing hurricanes and FEMA having to step in. Right. So no matter if you're on the West Coast or you're on the East Coast, we're starting to see foreclosure inventory is ignoring where you are on the map, and it's becoming a real home issue. And some of the data that you're seeing on your screen is that the foreclosure data has almost reached the pre-pandemic levels. So we're almost back to the 2020 levels where, the total inventory of delinquent loans was sitting about just under 2.5 million. And today it's just about 2.5 million.
Right. So, and you have to remember, a lot of that got delayed with the government forbearance plans and the foreclosure moratoriums. So we had a 2-year period where there really was no movement.
Stagnation,
right?
Because the government steps in.
So now in the last 2 years, we're back to the pre-2020 levels, right? And it goes right back to that affordability. I mean, there are some instances, like you said, the natural disasters, which impact not only the homeowners, the values, but people working and their jobs and stuff like that. But for the most part, folks are having a hard time making their payments, right? And they have nowhere else to go. We were talking earlier about institutional investors are basically the BTR, build to rent, right? Ground up construction. They're just instead of going out and buying homes that they can turn into rentals, they're like, you know what? We're not going to play that appreciation model where we're going to buy a distressed asset and hope that it appraises in 2 years and sell it. We're going to build a brand new house and rent it. And our timeline, our modeling is going to be way longer than 2 or 3 years. They're going to go strictly off a rental cap rate structure. So what do we do from a distressed property standpoint to turn our distressed property into homeowners or to housing opportunities? Like I like to say, there's two different things. There's a housing problem, and then there's a home ownership problem, right? Because housing, okay, what do you do if somebody gets displaced due to a hurricane or due to a wildfire, right? At this point in time, they may just need a place to rent. You know, they need a pit stop, so to speak, to kind of regroup and figure out what they're going to do. But the long term, the only way you're going to build net worth as an individual is through home ownership. A homeowner has 45% more net worth than a renter, right? And that's what it's going to take to have people like we talked about, your kids, my kids are a little older. In order for them to build that generational wealth, home ownership's got to come back. All right, Chaz, so we talked a little bit about the equity-protected MPLs. And not every MPL is going to go through the foreclosure piece. Right? There's a lot of homeowners that we work with on a regular basis to retain home ownership, right? There's government programs that help them reinstate their loan. There's loan modifications that we analyze pretty much on a daily basis to try to figure out what that homeowner can afford in order to stay in the home. And then when they start making their payments again, it becomes what we refer to as a reperforming loan.
I think it's a strategy we don't get to talk about enough, where over the 11,000 loans that we have bought and sold over the last decade, we have yet to have to displace a family out of those 11,000. So home ownership for us is still very much alive, and the ones that we do have to foreclose on take back happen to be on vacant properties. So we are providing a community impact to local residential neighborhoods throughout the country. So we've talked a little bit about certain investors that come and buy paper from us on a consistent basis, but a lot of what we do acquire, 40% of what we acquire wants to stay and continue to pay. A default happened because of a loss of job, a divorce, some sort of cancer, a disease. Something happened to cause you to default. And if we can get you back on track, not only is it a win for the homeowner, it's a win for us, because economically it's a win-win, because here's how. If you bought an asset at a delinquent and you can get it back to cash flowing, and you can get to that cash flowing to be able to season, not only is that a highly liquid investment that you can go in out and retrade at a later date, but it also could be traded as a mortgage-backed security, but it also can be traded as a refinance and a potential payoff for us as an investor, and even lowering the rate for the potential homeowner who could have been in a higher rated mortgage environment prior to us buying the loan, and now because the rate environment has lowered, they have a benefit to get a refinance and pay us off and also get themselves into a better or lower monthly payment. But 40% of what we acquire is a cash flowing strategy.
Right, and that's where our TradeDesk comes in.
Talk about that a little bit.
So our TradeDesk, for the most part, in our capital funds, we're buying distressed debt, right? And one of our exits is to turn it into a reperforming cash flowing asset and then retrade that asset. And what we like to say, revolve our capital so we get new capital in to deploy on new assets. So our TradeDesk looks to retrade that reperforming loan, right, to institutional as well as individual investors, right? We have a network of individual investors that are looking for cash flow, don't want their money in the stock market, right? They want what we refer to as mailbox money. They know a payment's coming in every month, right? They can get a certain return coming in. And a lot of folks that we deal with have self-directed IRAs. And yes, you can buy a non-performing loan in there, but if you buy a non-performing loan in your IRA, every advance and every expense you have on that asset has to come out of your IRA. So some people don't know what that may look like from an expense standpoint.
So slow that down for a second, right? So I can let's just say I have a 401k, and I want to move that over to become a self-directed. And now I've got the opportunity on my self-directed to buy non-performing, or I've got an opportunity to buy cash flow. To your point, non-performing, I've got to not only buy the asset, but the expenses and the upkeep on that asset I've got to continue to put out from my directed IRA to manage that properly effectively.
Correct.
To your point, though,
you cannot commingle funds. It has to all be out of that one IRA account, right, in order to stay as tax-free.
But if I buy cash flow, walk me through if I take the self-directed, I go and buy a 12 for 12, 14 for 14 payer, right? At one point they were non-paying, but now they've learned the behavior of making their on-time payment. Walk me through how I take my self-directed and start buying assets like that.
All right, so let's say you have a loan that has a $100,000 balance, right, and it's paying $700 a month.
Sure.
Right, and there's still 20 years left on it. You can buy that loan. Let's say you buy that loan at 90 cents on the dollar, right? And then all of a sudden we transfer servicing over to your IRA, and those payments, they still go to the servicer, but the servicer, instead of sending it to Revolve, sends it to your IRA every month.
Sure.
And all of a sudden, that
now
IRA builds in just like you're getting a month. It's just like you were renting. You bought a house in your IRA and rented it out. Except you don't have to fix toilets and worry about a tenant moving out. You're getting a mortgage payment coming in. And to your point, they've paid 6 out of 6, 9 out of 9, 12 out of the last 12 months. You see that steady cash flow. And we have a lot of investors that raise their hands and say, I've got some self-directed IRA funds, and that's something that interests me very much.
Look, here's a story I got about a decade ago. One of our investors that were buying consistently from us month after month. I had been selling him hundreds of mortgages. And at one point he looks at me and says, this is a trade we're doing. Hey, how many do you own? Right? And I'm like, I'm a young buck at the time, barely 30. And I'm like, I don't have any. I've been doing this for 7 years, but I haven't actually owned any myself. So today I own dozens of cash flowing assets that are backed by performing loans. Sure, I've got delinquency in there, but I've got cash flowing assets that hit us every single month. Me and you call it mailbox money. But if you got your money that's tied up in stocks, bonds, you got dividends, and you've got pension funds and IRAs that are bringing you different investment vehicles, you should look at collateralizing yourself behind notes, because you can buy a mortgage note that was originated in 2015. And COVID caused the default. So 5 years into the mortgage term. Now it's a 30-year rate that you got. 30-year amortization schedule. So 2015 originated, doesn't mature until 2045. 5 years in, they default. Now 3 or 4 years later, they get themselves back on track. Okay, they're now starting to make their monthly payment month after month. They've learned the behavior. Now, when you go to buy that mortgage note, how many years does it still have left on it if you bought it in 2025? It still has 20 years of income-producing months that you have in front of you, and or until you get paid off from the potential borrower who may take a refinance out. But what a passive way for you to be able to own real estate but not have to do any of the upkeep to do it. So we do encourage you to look at stuff like that.
Yeah, and you made a point, 20 years, wow, I got a 20 years worth of payments. That's a long time. Well, somebody could refinance. Somebody can move and sell their house and pay you off, right? And if for some reason you needed to churn that capital in your IRA, to your point earlier, that note is liquid. You can go out in the marketplace and sell that note out of your IRA. Now, the funds you sell it for will go back into your IRA for your next investment.
Recapitalize your IRA.
Right. So there's different ways to do that. Don't think you're getting stuck with $700 payment for 20 years. 5 years down the road, what am I going to do? You can always retrade that note, or most likely, somebody's been paying on a reperforming loan, they can refinance.
Sure.
All right, Chaz, we've covered quite a bit, from non-performing loans, the equity protected piece, the foreclosure piece, all the way to reperforming cash flowing assets using your self-directed IRA. And we mentioned the TradeDesk, and I want our audience to know that we continually, through our TradeDesk, put out offerings. Whether it's on a monthly or a bi-monthly basis, you can go to TradeDesk at revolvecapital.com and sign up, be one of our approved investors, get in our database to where you receive these mailings and you'll know when an offering comes. And you'll have an opportunity to take a look at the offering, make a bid on the assets that interest you, whether it's cash flowing, non-performing as well. And if you would rather be more passive, and would rather just, tell me a little bit more about your capital funds. You can go to revolvecapital.com and learn about our capital fund and how you could be an investor in that. We have a couple of what we call now Evergreen Funds, and you may want to just give a little, two sentence kind of elevator pitch on what an Evergreen Fund is, why we have it, and how they can learn more.
Look, we wanted to set up vehicles that allowed our clients, who were more than just clients to us, they had become friends in the business, and life is busy. So for them to be able to manage a note portfolio themselves, like they had been doing for years, no longer suited their lifestyle. So being able to park capital into a fund that was backed by notes, again, single-family homes throughout the country, is providing a vehicle that said, look, whether you want to be with us in a short duration, so give yourself kind of more of a higher liquidity turnover, but didn't have to be locked up for a certain period of time. We had vehicles that were catered to that. Then we also created vehicles that allowed you to be with us for a runway and give yourself a consistent distribution from us that was backed by cash flowing assets as well as low risk, non-performing assets. So these vehicles have been established for years, track record that's been there, well over thousands of assets to provide stability. And we use a lot of data and regression analytics to be able to get ahead of potential blips and changes we may see macro-wise in the market. But these vehicles were built for folks that no longer could be hands-on with real estate and allow themselves the passive ability to diversify and look at an alternative investment vehicle that provided them safe and consistent returns.
So at Revolve Capital, whether you're an alternative investor looking to be active or passive, right, we have investment opportunities for you, whether it's buying one note, a small pool of notes, or investing in one of our capital funds. So again, TradeDesk at revolvecapital.com, or go to our website, revolvecapital.com. And also make sure you like and subscribe to our podcast here, and we look forward to sharing more and more industry data with you so you can see the reason why being a note investor is a great opportunity. Chaz, as always, it's been fun. And hopefully it's been informative to everybody. I look forward to our next episode.
Great stuff, brother. Cheers.